The market has just delivered a once-in-a-decade opportunity, dropping more than 20% from its all-time high. The question is, how can you take advantage of it? In this video, we'll walk you through how to use option structures like ratios to benefit from current elevated implied volatility levels. These tools can give you a real edge in this environment. If you're a long-term investor, you're probably fine just buying Delta 1 instruments, futures or cash positions, or dollar cost averaging into them. But that doesn't mean you should ignore what's happening in the options market. Current pricing in optionality presents a chance that shouldn't be missed. This is even more true if you're a trader or short-term oriented. We all know options are useful because they offer convexity and asymmetrical payoffs. But what we're focusing on here is what happens to their pricing after sharp sell-offs, like the one we saw in March 2025. Markets fall faster than they rise. Case in point, the S&P futures dropped 10% in just days at the beginning of April, falling from 5,670 to 5,070. That same move up had taken nearly 6 months from February 2024. Why? Human psychology. Once fear kicks in, people stop thinking rationally. They sell aggressively just to reduce risk built up during calmer periods. If you're not outright selling, you're probably rushing to hedge your portfolio with puts, or switching from Delta 1 exposure to calls to limit downside. That gives you similar protection to buying puts, thanks to put-call parity. The preference often comes down to tax treatment or other specifics. This panic drives up the price of options, even beyond realized volatility, lifting the entire volatility curve. That's the first key point. Implied volatility rises during sell-offs, which is easily observed via the VIX, known for its negative correlation with stocks. The second thing that happens, puts get bought more than calls. Losses hurt more than wins bring pleasure. That's why the volatility curve normally has a positive skew. Puts cost more than calls. In sell-offs, this skew becomes even more pronounced, with far out-of-the-money puts gaining even more premium relative to closer strikes. This brings us to our first actionable takeaway. After a sell-off, you want to be selling options due to high implied volatility, especially puts due to skew, and more specifically, far out-of-the-money puts. This doesn't mean you should never buy options when they're expensive. If you're expecting realized volatility to be even higher than what's implied, buying might still make sense. But it's risky. You could get the direction and timing right and still lose money. Why? Because implied volatility drops as markets rise, meaning the calls you bought might lose value even as the market goes up. This is the classic vol crush effect. You lose more from the drop in implied volatility than you gain from delta exposure. That's why selling puts can be more forgiving. The opposite dynamic works in your favor. Another critical concept is term skew, or how volatility is priced across different expirations. During times of market stress, people rush to buy short-dated options, weekly or even 0 DTE, to protect their portfolios. These options are high in gamma and react sharply to price moves. This demand bids up the shorter expirations, sometimes inverting the usual term structure. This leads us to our second takeaway. This inversion is not normal and tends to mean revert. So you want to focus on selling shorter-dated options more than longer-dated ones during these periods. The main point you should learn from this video is, if you understand how Greeks change with the underlying's price, you can create combinations that exploit these short-lived mispricings, such as the ones we just mentioned. Earlier we mentioned ratios as a strategy. One of the most effective during sell-offs is the put ratio. It's simple. You buy one out-of-the-money put and sell 2 lower delta puts. This setup benefits from high positive skew, as you're selling the more expensive options. You can structure the ratio to be done for a cost, at 0 cost, or even for a net credit. Combined with a Delta 1 long position, this gives you protection in case of further decline at very low cost. The downside? If the price drops below your lower strike, you're doubling your short exposure. But if you're using this on something like S&P futures and you're comfortable adding exposure at lower levels, this is a powerful way to catch a market bottom. In times of panic, you can even set the strikes far apart. For example, in the recent sell-off, you could have bought futures at 4,850 and set up a 2-week put ratio to protect down to 4,500 for 0 cost. That's a 7% downside bet we're willing to take. Be mindful, since the strategy carries a long theta position, the short puts lose value fastest near expiration. If the underlying starts dropping right after you enter the trade, your mark-to-market might look painful initially. This is also why, with inverted term skew, shorter expirations are often preferable. The risk is short-lived, and the mispricing is most extreme there. Now, when you have a basic idea what you should be looking for, open up your brokerage account and take a look at how the volatility surface has changed in the last week or even month and how you can use it to your advantage.